Hello, in this presentation we will continue with Chapter 8 and we'll be discussing cash equivalents and liquidity. Now we're going to start with controls over cash. So when we're thinking about internal controls, first thing we're going to apply it to is cash, and this would seem intuitively correct to do that because cash is one of our most liquid assets, one of the easiest things for people to steal and most desirable for individuals to want to steal. So that would be the area to start with safeguarding in internal controls in order to have controls over that cash so that we can detect and prevent the theft of it. So an effective system of internal control that protects cash and cash equivalents should meet three basic guidelines. First, handling cash is separated from record keeping for cash. So whenever we think of internal controls, whether it be cash or any other type of account that we're putting controls over, we want to think of separation or segregation of duties, meaning that we generally want one person, in this case handling the cash, to be separated from the person recording the cash. Why? Because that means that in order for a theft to happen, they would have to get together and both collude together and come up with a plan together in order to cheat the system in such a way that a theft could happen and it could not be easily detected. That for that reason, we generally often in a kind of more bureaucratic system, the larger the company is, the more of these controls we have, which is basically a form of bureaucracy, a system we're putting into place in order to safeguard the assets, is a system in which people getting together and is almost bad. It's called colluding to do something that will circumvent the internal controls over the cash. So we also want cash receipts are promptly deposited at the bank. So if we're basically a small store that gets a lot of cash, or any store that gets a lot of cash throughout the day, it's a good idea to actually take that trip to the bank at the end of the day, deposit the cash for multiple reasons. One, we don't want to have all that cash on hand because that's a risk, an inherent risk in and of itself to have the cash on hand in one place. And also, if we deposit it into the bank, it gives us some general record of how much we have been pulling in from day to day, because of course the bank has records and they will keep track of the deposits on their end as well. Cash disbursements are made by check. So if we put the checks going out, we don't really want to pay for things with cash. We want to pay for them with a check. Why? Because it's a better paper trail. Generally, we want a larger paper trail. We want to have more of a paper trail. Even in the smallest type of business, oftentimes we'll have someone in charge of the accounts payable creating the checks, but we don't generally want to give them a rubber stamp of our name to give out the check, to send the check. Usually we still want to keep that control on ourselves so that we can then approve the check. So once again, we have that two individuals involved at least. Even in a small business, someone could create the checks, but they have to go get that approval and that signature from somebody else in order to send out the checks. And that's another safeguard of the internal controls. Cash equivalents and liquidities. Cash and similar assets are called liquid assets because they can be readily used to settle such obligations. So whenever you hear this word liquidity in terms of an accounting term, that generally means something that is closer to cash, and more precisely, it's something that can be readily used in order to buy services and goods. That's basically what the invention of cash is. So we may have a lot of great assets, such as if we were in a real estate company, we may own buildings and have a lot of property as our assets. But that assets are not liquid, even though they're very valuable, because in order for us to convert that property and buy goods and services with it, it's a long process to do that. Cash, on the other hand, is something that we could buy and sell more easily. So therefore, the liquidity, the definition of liquidity, is something that's generally closer to cash, cash being the invention that we have that allows us to trade more easily and buy goods and services with it. So cash, currency, coins, and amounts on deposit in bank accounts, checking accounts, and some savings accounts are equivalents to cash. Also includes items such as customer checks, cashier's checks, certified checks, money orders, all considered cash. Cash equivalents, short-term, highly liquid investments that are readily convertible to a known cash amount, close to maturity date, and not sensitive to interest rate changes. So, cash management. The goal of cash management are twofold. Plain cash receipts to meet cash payments when due. So planned cash receipts, that should be. So obviously our goal in cash is to have enough cash on hand, enough liquid assets in the form of cash, so that we can pay our current obligations. Current obligations coming up, we need to be able to pay them with cash. We want to have a minimum level of cash necessary to operate. So clearly we want to have the cash on hand in order to operate. Now notice what the goal is not to have of business, which I think a lot of people have this vision of the goal of a good business is to pile up cash and have a huge store of cash either in the bank or in some kind of warehouse. That's not the goal of cash, because if we do that, then we're not using the cash effectively, because we're missing out on the opportunity cost of cash, which is that we can at the very least put the cash into the bank, and if the cash, just like any other asset, is not being used in order to help us generate more revenue, then it should be put back into the business, or it should be given to the owners so that the owners can either use it in their personal lives or put it into their personal savings accounts. So the goal of business is not to have a pile of cash. And I think one of the examples of this, which is kind of a misconception, is like an illegal type of operations in movies, and what like if it was a drug operation and they're doing really well, and they prove they're doing really well by having this warehouse of cash that they can basically jump and swim in. A business person looking at a warehouse of cash like that would probably think that's incredibly inefficient, because that cash is not helping to generate any more cash. So, and obviously that's a problem in an illegitimate area, because there's a problem with investing cash because no one knows where it came from. But clearly to have a warehouse of cash is not the objective. The objective is to keep the cash working for you by putting it into something. And if there's nothing that needs to be put into, then it should be drawn out for personal use to the owners. So effective cash management involves applying the following cash management principles. Encourage collection of receivables. So if we have receivables out there, we want to get them as early as possible. And this can seem kind of small, like small peanuts. Why it doesn't really matter if I get it today or if I get it a month from now. But when you're talking about a lot of transactions, if we get the money earlier, then we can invest that money. So if you're talking about credit card companies or something like that, which have a lot of transactions per day, if we can get on average those transactions coming in sooner, we can put that money to use a lot quicker. So it is a big deal to get the receivables in sooner. And for smaller companies, it's a big deal just so they have the cash flow in order to pay their current obligations oftentimes. So delay cash payments. On the liability side, of course, again, the same idea. If we could pay the payment today, or if we can pay it a month from now, we'd rather pay it a month from now. And again, it may seem like a small difference, but when you're talking about a lot of, and if we have a very few transactions, it is a small difference. But if we have a lot of transactions, that becomes a big difference, and it becomes something that companies really do take a look at and really can affect the bottom line. So keep only necessary levels of cash. We don't want to have piles of cash. We want to have our cash working for us. So the goal of business is not to have a pile of cash. The goal of business is to have assets and have the necessary cash to meet current obligations comfortably, while having the rest of our assets invested in such a way that we are optimizing our returns and getting the most money on that. The cash should be working for us in some way. Plan expenditures. Obviously, we want to plan what type of expenditures we have, and we want to invest the excess cash in some way that we can get the highest return on it. So controls over cash receipts. So the classic control is going to be a cashier register type of situation. So if we're in a store and we have a cashier, we have a register, then the cashier clearly has control over the cash. Ideally, they want the cash to be in a register, and when the transactions are recorded in the register, and the cashier does not have access to the tape in the register. And so the register is recording the transactions while the cashier is recording the cash. The cashier should clearly display the entry of the information into the register, and they should be confirmed by the customer, should be able to see the transactions, and that's part of the internal control. The cashier could then either count it or give it to someone in the cashier department to count the cash, record how much cash was collected, and then a separate individual, a supervisor, would then often record the transactions from the register. So note the register has the transactions, and if we make the recording process separate from the cash handling process, then the supervisor would record it, the cashier would be handling, the cashier department handling the cash. We separated the person entering the data from the person handling the cash. Therefore, if, say, the cashier took cash from the system, then when we record it, then the deposits would not match up the record that is in the cashier. So that's the safeguard that we generally have. Now, in thinking about internal controls, we often, it's interesting to think about what types of things can circumvent the internal controls, and then how can we solve for those? Because of course internal controls are not perfect, and there's always going to be a way that they can be circumvented, and we as the business want to implement more ways to prevent that. Also note that this system of separation of duties is more red tape. It takes longer. It's a longer process. And as businesses get larger, we need more of this kind of bureaucracy in order to safeguard assets, because the business becomes less and less, personal, and therefore the likelihood for, theft and fraud and whatnot increases. So, what are some kind of ways that this can be circumvented? Well, one, these two departments can collude and get together. What if the cashier department then went to the supervisor and said, hey, you record this and do that? Then that's one way that a problem. Collusion, two people getting together in different departments and colluding together is a problem. It's less likely to happen than having one individual involved. Another thing that you might think, well, what if the cashier said they record the sales and then they recorded that the merchandise was returned or something, and that it broke or something like that, or it spoiled? Then the cashier could record in the cashier the return of the merchandise that didn't really get returned, throw it away if it was a sandwich or something, and then take the money out. And how can we safeguard against that? Well, we might have to have a supervisor that approves any kind of return or any kind of error in the implementation on the cashier department into the register. Another common thing that a register might do: what if we pretend we're putting it into the register, but we don't, and we just get the money? Then we got money and we didn't record the thing in the register, and therefore it's not going to be on the tape, and the register will tie out. How can we safeguard against that? Well, part of that is that we should be clearly showing the customer the receipt in the register. So the customer's actually part of that internal control. And if that happened a lot, we would also be counting the inventory and see if the inventory is matching up to the final count of the end of the day. So there's just a couple things to think about when you start thinking about internal controls. These are types of things that we can go over on. Cash over short account. Sometimes errors in making changes are discovered from differences between the cash in the cash register and the record of the amount on the cash receipts. So if a cash register recorded 550, but the count of the cash in the register is 555, we would prepare the following entry. So note, when we go to the bank, we have 555. We're going to go deposit that in the bank. But the sales receipts that we got from the register separately say only 550. Therefore, there's a difference, and we're just going to stuff that into this account called over and short in order for our debits and credits to be equal. Hopefully this over and short is small and therefore immaterial, and so it's not going to have a huge effect on our differences. Obviously, if it's a large amount, we're going to have to look into it and see what's causing this over and short account. Sometimes the difference can go the other way, of course. On the other hand, if the cash receipts recorded 625, but the count in the cash register is 621, now the cash that we deposited is in this case 621 is short of the actual sales. And you would think that would be the more likely thing to happen. Like if something funny is going on, you'd think that the cash that we have is less than the sales that were recorded if someone took something or something like that. But it can go either way, and either way does indicate something weird is happening. So if something is being recorded that shouldn't be recorded, we need to go in there and take a look at that. Again, if it's a small difference, then it may be someone miscounted when they gave back the cash or whatnot, and that could result in it going either way.